value the bonds, right? So how did we value the bonds? What's the base for the valuation? Valuation is based on the intrinsic value of the asset, right? So what do you mean by the intrinsic value of the asset? Intrinsic value, how you can calculate the intrinsic value? Present value of all future cash flows, right? Present value of the all future cash flows is considered as the intrinsic value. So then regarding the bonds, how many cash flows do we have? Regarding the coupon bonds, how many cash flows do we have? We have two cash flows, but those two cash flows are very good. It's coupon payment and the other one maturity price. So therefore, the value of the bond is comprised with the present value of all future cash payments from the dividend plus present value of all or else present value of the maturity price. So this is what we have discussed up to now, the valuation of bonds. I hope up to that point it's clear to you all. So then we'll discuss with the relationship between the current interest rate, current market interest rate, and then the bond price. What sort of a relationship is there? And then we'll identify the classification of bonds. But the trading price classifications, whether it is trading at par or else whether it is trading at premium or else discount based on the changes of the interest rate and the coupon payments. So that's our target. After that, we'll identify the valuation of shares and complete the lesson. Okay. Okay. Question number 8. Quickly do the question number 8. So this is based on the last week, the knowledge. If you are unable to complete the last week notes, now you have the chance to complete the or else gain the knowledge from the. If you are unable to present the last week, now you can have the chance to take the advantage of it. Quickly doing. Yes.
We can't see the board.
Okay, right. So I will share. So you have that one. I will share the screen. We are doing the question number 8. Now okay, no?
Now okay, teacher.
So we are discussing the question number 8. Quickly do it. Summarize the information first and then identify the value of the bonds. It's very easy. Present value of all future cash flows. That's the basis. Right. You read the question. ABC PLC, they issued the 5-year annual coupon bond. It's a coupon bond which pays 12% per annum with the face value of 1,000. If the yield requested for the investor in this market is 15% per annum, that means required rate of return is 15%. How much will you pay to purchase the bond of the ABC PLC if the interest rate changes to 13% as well as if the interest rate changes to the 20%? Three incidents. First one R equals to R equals to 15%. Second one R equals to 13%, and then the last one R equals to 20%. I'm not going to do it. You have to do it. I'm not going to do the calculations. You discuss with your friends and do the calculations. So this is 5-year annual coupon bond. That means N equals 5. Right? Coupon rate, it is 12%. CR equals face value equals 1000, and then required rate of return, that means R equals 50. First scenario, or as the initial question, what is the price of the bond if the current, what is the price of bond if if there are set of condition like that, that means CR 12, N5, and then the R equals 50. So this is what I have calculated, right? Can you understand this one? You all can do it your own way, no issues. But for the simplicity, I have taken the final answers like this. Okay. Do your calculation and cross check whether you are getting the same answers. What's the base for the taking the bond value? It's the present value of all coupon payments plus present value of the maturity value. Right? So we have 3 scenarios which have been highlighted here. In the first scenario, second one. This is the first one, second one, and the third one. I don't have the question. Okay. First scenario, and this one is second scenario. Right? Second scenario, and then the third scenario. Right? DF means, what do you mean by DF? R. Then last week we identified R equals, in the first scenario, R equals 15%. The second scenario, R equals 13%. And then the third scenario, R equals 20%. What do you mean by R? Required rate of return. So we have two set of cash flows. What those two sets? First one is the coupon payment and the other one maturity price. Right? First year and the fifth year, we are getting same set of cash flow. What is that? Same set of cash flow. Same cash flow we identified in the last week as the annuity. What is that? That is annuity. That is the sum. It's a coupon payment. Right? So we have the coupon payment. Calculate the coupon payment with it. Coupon payment. Coupon payment ඔයාලට තේරෙන විදිහට හදන්න මම මේක මට ලේසි විදිහට මේ පෙන්වන්න තමයි ඔයාලට දාලා තියෙන්නේ. Working number one. Working number one for the coupon payment. Right. Coupon payment. Coupon payment equals. Tell me how we can calculate the coupon payment. Very good. Face value multiplied by the coupon rate. How much is the face value? 1000. Coupon rate 12%. So then coupon payment, how much is it? It's 120. 120. You are getting 120 during 5 years period. During 5 years period. And then at the end of the 5th year. At the end of the 5th year, what you are getting? What you are getting? The maturity value. What is the maturity value? The face value here, it is how much is it? It's 1000. Now take the present value of this coupon payment as the annuity and then present value of the maturity price 1000. Since this coupon is an annuity, I have taken here annuity factor. Annuity factor is 3.52. By multiplying this coupon payment with the annuity, I have taken the present value of the coupon payment is 422.04. Last one, or as the second cash flow, that is the present value of the maturity value. Maturity value is 1000, but after 5 years period, so therefore you need to convert that 1000 into the present context by multiplying it 0.4. 0.54. So therefore, we are getting the present value of this 1000. It is 542. 542. And is present value of the coupon payment plus present value of the maturity price. You are getting the value 964.04 if the R equals to 13%. No need to copy this one. You do it as the way how we do it in the last week. මේක මෙහෙමද ගන්න ඕනේ නැහැ. අපි හදුවාට මතකද PV multiplied by the annuity factor likewise. මතකද ගන්නවද? So these are three scenarios. First one, R equals 15%, coupon equals 120, interest towards R, PR equals 12%, and then face value 1,000. Like the value of 1 equals. Right, value of 1 equal coupon payment CR multiplied by the annuity factor. How you can take the annuity factor? 1 minus 1 divided by 1 plus R to the power n divided by the R. Plus face value divided by 1 plus R to the power n. Did you remember this formula? This is what I have summarized in the given paper. Right. CR, how much is it? Coupon payment 120. 120. 1 minus 1 divided by 1 plus R. How much is R? What's the R now? R is 15% divided by 5 plus 0.15 for how many periods? How many periods? For 5 years. For 5 divided by 0.15. Who's that? Future. Plus face value, present value of the face value 1,000 divided by 1 plus 0.15 R. So then to the power 5. This value equals to 400. Scenarios තුනටම හදන්න බලන්න බොන්ඩ් වැලියු එක කීයද කියලා. දැන් තේරුණා? මම ලේසි එකක් හොදගත්තා. Are there any control tools? The animation factor is 3.35. 3.35 multiplied by 120 plus the last one is 497. Both together, the value of the bond is 899.99.2. 899.24. But you need to change things. So this is the first one. R equals 50. Right? Second, what happens? R changes to. R changes to the second scenario. The required rate of return or else the current interest rate has been changed to which ratio? To which ratio? 13%. The first one is 15%. Second one, 13%. Third one, required rate of return or else the current interest rate has been changed to 20%. Now the second one, R equals 30%. Other condition same as it is. Right? N equals 5. Coupon rate equals 120. Face value equals 1000. Now the formula. One value equals. One value equals. Right? Coupon rate. Coupon payment. We can make it as a coupon payment. So here it should be coupon payment. Coupon payment multiplied by the annuity factor. What's the annuity factor? 1 minus 1 divided by 1 plus R to the power N divided by the required rate of return R. Same annuity factor. Plus present value of the maturity price. Face value divided by 1 plus R to the power N. Right. Coupon payment 120 multiplied by 1 minus 1 divided by 1 plus R. Now how much is the R? R is 13%. That means 0.13. To the power how many years? 10 years. 5 years. Divided by R again 0.13. Close the bracket. Plus face value 1000 divided by 1 plus R 30. 0.13 to the power 5. Annuity factor is 3.52. Annuity factor is 3.52 multiplied by 120. Plus the present value of the redemption price is 542. Both together we can identify it as 900 64.04. Right. Now again, current interest rate has been changed to, in the third scenario, interest rate has been changed to which ratio? R has been changed to R equals now 20. Now do it. First required rate of return or its interest is 15, second 13. Now the last one it is 20. Try to do it. Third scenario. Nothing new. The same formula you need to apply by changing the R. That's it. Take up the calculator. Take out the calculator. So this is the even the continuation of the last lesson. So it's what we are doing in practice in last week question. Right? Read the question number 8 and some this one, first one and second one. Copy that one to your handbooks. So we do the third one. Otherwise, as a strategy, what you can do is you can go to the places where the last week students were presented. Anyone who presented in the last week? Coordinator. 18C exception coordinator. Agamini was there. You understand the last week session? Entire concept? Yes, stand up and ash color t-shirt. You also two ash color t-shirt. Yes. What's there? Last week. Why you are laughing? Come. Come. Yeah, it's here. Stop talking and do it. Yay! Again, right? If you can't understand again, right? Okay, write it down. Base for the valuation. If you are unable to present in the last week, write it down. Valuation base. Base for the valuation. Base for the valuation. Base. Base for the valuation. What's the base for the valuation? Intrinsic value. Right? Write it down. Base for the valuation is intrinsic value. Intrinsic value. Intrinsic value. Right? Second line, write it down. Intrinsic value equals to. Intrinsic value equals. Intrinsic. Oh, intrinsic. INTRICT. Intrinsic value. Intrinsic value equals to present value of all future cash flows. PV of all future cash flows. PV of all future cash flows. Now, third line. Third line. For a coupon bond. Third line. For a coupon bond. For a coupon bond, there are two future cash flows. Third line. There are two future cash flows. They are. Next line, fourth line. Coupon payments. Coupon payments. Coupon payments. Coupon payments for holding period. Coupon payment for holding periods. Fifth line, second cash flow. Redemption price. Redemption price. Within brackets. Within brackets. What is it? Face value. Face value. Right. Face value. Next line. Sixth line. Coupon payment. CP. Coupon payment. CP. Coupon payment. Equals. CP equals face value. Face value multiplied by. Face value multiplied by coupon rate. Coupon rate. Right. Now, with that knowledge, we'll go to the question number 3 and 2. Okay. According to the question number 3, what are the information that we have been given? R equals. Now go to question number 3. Give me my mobile. I'm not going to be. Take out the mobile and read the question. Or else, I have given the handout from the last week onwards. You should have the hard copy of handout. Okay. Without calculators, without handouts, you can't do the calculations. On the price, the other one. Okay, so I hope you already gave the question. Three by third one. Third point, yes. Oh, third point. If the interest rate is 20%. Right. Okay, read the entire question. Face value is 1,000. Right? Interest rate 20%. Third scenario, so we are doing the second one. That means third scenario. Right? R equals 20%. Coupon payment equals 120. How you can take 120? 1,000 multiplied by 10%. N equals 5 years. Let's see. Right. N equals 5 years. Coupon rate equals 12%. So then coupon payment CP. Coupon payment equals face value multiplied by coupon rate. That is 120. Right, 120. How we can take the value of the bond? It's comprised with two components. What those two components are? Value equals coupon payment. Coupon payment, this becomes an annuity. This becomes an annuity. So therefore, how we can take the present value of this annuity by multiplying this CP or coupon payment with the annuity factor. How we can take the annuity factor? 1 minus 1 divided by 1 plus R. To the power n divided by entire formula should be divided by the required rate of return R plus present value of face value 1,000 divided by 1 plus R to the power n. Why it is n, or is divided by 1 plus R to the power n, converting it to the present value. Right. CP it is 120 multiplied by 1 minus 1 divided by 1 plus R. R is now 20%. To the power, how many years we are keeping or we are receiving this coupon payment?
5 years.
5 years. So therefore, to the power 5. To the power 5. To the power 5 divided by 0.2. Thus, face value. How much is the face value? Face value 1,000. Face value 1,000 divided by 1 plus R, it is 0.2 to the power 5. What's the first part then? It is 358. 358 for the present value of the coupon payment plus. Second one, it is 402. That means present value of the face value, it is 401. Both together, how much is it? 759. 759.9. Okay, no? Right. Now summarize the information. Summarize the information quickly. You take the two column table. Right? First row R. Right? Summarize the information of these three scenarios. Right? Take the two column table and present it. Whereas the first column, it should be R. Second column, the bond price. Right? R and then the bond price. Okay, we have 3 hours, 30, 15, and 20. If that changes, we have 3 values. 3 bond values. So this is the summarized information. Interest rate or else yield or else R. We changes it to the 13, 15 and 20. If the interest rate is 13%, bond value is 964.04. Right? If the interest rate changes to the 15%, what happened to the bond price? It has been reported as the 899.24. If the interest rate changes to 20, what happened to the bond price? Bond price reported as 759.8. If you graphically illustrate this scenario with the required rate of return or else the interest rate and then the bond value, bond price. That you can have a which kind of a relationship? Which kind of a relationship? Leo, which kind of a relationship with the interest rate and the bond price? Positive or negative? Positive. Okay. Very good. Is that positive? Yes, is that positive? If the interest rate increases, what happened to the bond prices? Decreases. So therefore, we identify there is a negative relationship or else inverse relationship with the current market interest and then the bond price. We call it as an interest rate risk. Okay, write it down. Draw this one and write it down. Quickly draw this one. Draw this one. Okay, write it down. Now write it down. Write it down. If the bond price, if the market interest rate, write it down. If the market interest rate, increases, if the market interest rate increases, bond prices decreases, which imply there is a negative relationship. There is a negative relationship within brackets, inverse relationship within brackets, inverse relationship between market interest rate and bond prices. Is this a favorable scenario or else a risk situation? Risk. Why? If the market interest rate increases, what happens with the bond prices? Bond prices always tend to decrease. So therefore, write it down. This is called as This is called as interest rate risk. This is called as interest rate risk. Hope it is very clear to you all. Right. Now, if you are unable to do the calculation, the question number 9, do it, same platform, you just need to identify the figures and then calculate the bond prices. Quickly do the question number 9. Again, you make the 3 columns and same set of question, similar to the question number 8. Giving scenarios, only the thing is here it is going to be changed the again market interest rate 8, 12 and 10. Quickly do it. I'm not going to do it. I'm not going to explain it. I'm come up with the answer. So therefore, it's your chance to do it. Some of your friends has been completed it already. අර වගේම තමයි වෙනස් වෙන්නේ R. Now we have done clear points. Now you can sort it out. To discuss with your friends and doing something. Purple color Pure calculated prices of bonds. Right? So then we go to fix them. So this is how I have calculated the prices of bond regarding the if the coupon payment is 10%, the value of bond is 1,000. If the coupon payment is 12%, the bond value is 850. And then if the coupon payment is 8%, interest rate is higher than the coupon payment, the bond value is 1,196. Now, draw this table quickly. Draw the table quickly. Right, what it include? We are discussing about 3 scenarios, and then in these 3 scenarios, coupon rate is 10%. So therefore, it's a constant one. Coupon rate is 10%. First scenario, coupon rate 10. Second one, 10. Third one also 10. Yield rate, that means interest rate. Draw it with me. Interest rate in the first question. First question. The first one, 10, 12, and 8. Accordingly, what happened to the interest rate? Interest rate changes 8, 10, and then 12. Right? In this, each scenario, face value equals to face value 1,000. Does the face value changes? No, face value again constant. Now bond value. Tell me the bond value. Okay, tell me the bond value. If the interest rate is 8 and then the coupon rate is 10%. Tell me the bond value. Bond value, how much is it? Bond value. We have calculated the 1,196.36. Right. Tell me if the bond value, if the coupon rate is 10% and yield is 10%, what's the value of the bond? It's 1,000. So the last one, if the interest rate is 12% and then the coupon rate is 10%, Leo, what's the value of the bond? What's the value of the bond? 100. Tell me your calculated value. Calculated Now take it. So, third scenario, what's one price? 850. Now, if the coupon rate is similar to the now look at here. If the coupon rate is equal to the bond rate, the yield rate 10 to 10. Face value and bond price is equals to the 1000, right? Coupon rate, yield rate, similar. If it is so, what happened to the face value and bond price? Face value and bond price equals to the same value, right? So where we identify the bond is traded at which value? Par, right? So we name it as bond is traded at par value. Traded at par value. Right? What is this explained? What do you mean by the coupon rate? That is the rate offered by the company as our income. Right? Yield rate, what do you mean by yield rate? That's the investor's expected returns. Now in this second scenario, what happened? The company offers what the investors expect. So therefore, two rates are similar to each other, whereas we can identify the real value of the bond is equal to the face value. We call it as a trading at par. Trading at par. Right. First scenario. Coupon rate is 10% and then the yield rate, current market interest rate is 8%. What is this company offer or else the invested company offer 10%. Even we expect 8%. Is that a benefit? Yes. Benefit? Yes. So therefore, what happened to the bond price now? See the bond price. The real as the face value, more than what now 1000. What the real value is? 1196. That is benefit to us. Why? We can sell it as the investor. We don't need to keep the investment. We don't need to keep it on until the 5th year. What we can do is we can sell it. So therefore, we can call it as a bond is traded at premium, which is higher than the face value. Right? So therefore, traded at premium. Third one, what happened in the third scenario? Third scenario, what happens? We expect 12%. Now the current market interest rate has been increased to the 12%. Even it is so, the company is paying the coupon payment. How much is it? Dilip, how much is it? 10. Right? We expect 12. That is the interest yield. No? බලාපොරොත්තු ගන්න. මේක මොකද? company එක දෙන ගන්න. එහෙනම් company එක දෙන්න කිව්වද? 10. But our expectation is 12%. Right? So is that a advantage or disadvantage? That's a disadvantage. Right? So therefore, what happened to the face value? Face value remains stable, that's 1000. But the value of the asset, value of the bond is has been declined to the 850. We call it as a traded at which value? Traded at discount. Therefore, you mark it if the interest rate is higher than the yield rate and interest rate is lower than the yield rate. Exactly, bond value is higher than the face value. Here, bond value is lower than the face value. So these are really important things when it's come to the bond valuation. Right. You can do the question number 10 as a homework. So this is the end of the bond valuation lesson. Any questions on the bond valuation lesson? Do you have any question on bond valuation? Okay. Hope you don't have any questions. So then we'll move to the other concept, valuation of shares. Right? Valuation of shares. Do you need a break? Okay, have a 5 minutes break. 10 minutes. You report it officially, I will take action. You can have a 10 minutes break and come quickly. It is almost for morning, come and coffee. Yeah, the lecturers give you the assignments, group assignments. Okay, we'll start. Okay, can we start? Where are you students? It's a new session. You don't need to have the idea regarding conservation. This is a new one. So then with that knowledge, you can learn as well. Anyway, if you are not fluent in the conservation, don't forget about the conservation now. Share valuation is a new thing. Right. Online students. Online students. Alright, can you hear me? Okay, so we are starting the new lesson, stock valuation. Right, make the heading, stock valuation.
Yes, miss, we can hear you.
Right, thank you. Right, stock valuation. As we all know, how many stocks do we have? We have, yes, what are the two types of stocks? Same name for the stock is shares, right? Even you call as a shares or a stock, same names, right? Similar names. So then, what are the type of stocks? What are the type of shares? Yes, we have two type of shares. What those are? Two type of shares. Ordinary shares, very good. And then the other one, preferred shares. Right? So in this lesson, we are going to value the both ordinary share as well as the preference shares. So we identify first the different classes of the stocks. What is the shares? That means ordinary share types and then the preference share types. And then we'll identify how we can value the stocks according to each technique. The first one, make the heading. Ordinary share valuation. Main heading, stock valuation. Under that one, ordinary share valuation. Slash common stock valuation. Ordinary share valuation or common stock valuation. Now we are going to value. Right? So if it is a valuation, what's the basis? For the valuation, what's the basis? Intrinsic value, right? Okay, write it down. Valuation base, again write it down. Valuation base is intrinsic value. Intrinsic value of share. Intrinsic value of share. Okay. What do you mean by an ordinary share? Before moving to the valuation, we have to identify what is meant by an ordinary share. Right? So what is meant by ordinary share? In what sort of scenarios companies issued the ordinary shares? Yes. Company need to raise the capital, so they issue the equity shares. Right? So what's the specialty of equity shares? We compare to the other type of shares. What's the specialty of the equity shares? Or as the ordinary shares, we compare to the preferred shares, ordinary share holders, they are not entitled for the fixed dividend. Right? If it is an ordinary share, you invest in the company ordinary share. In return, what you get? Very good. In return, you can get the dividends. What do you mean by dividends? Lavasha. Right? If you invest in a company share, in return, annually or semi-annually, in the form of constant or else the fixed dividend or else interim dividend, in the form of those three, you are getting dividends in return. Right? Okay. What is the other cash flow, which is in line with this ordinary shares? First one is you are getting the dividend, which is similar to the coupon payments that we have calculated in the bond valuation. Bond valuation එකේ නම් හම්බෙන values එක මොකක්ද? Cash flows දෙක මොකක්ද? මොනවාද cash flows දෙක? coupon payment හම්බෙනවා, ඊට පස්සේ හම්බෙනවා මොනවද? විකුණන්න හදන price එක. විකුණන්න මොන value එකකටද? Maturity value or else redemption price. මෙයාගෙත් එහෙමම තමයි. During the holding period, what you are getting? Dividends. And at the end of the holding period, if the investor required, he can sell the shares to the other person. Right? Therefore, the next year's selling price plus dividend present value of dividends equal to the valuation of or equal to the value of a share. That's just basis we discuss in detail. Alright. So do the ordinary shareholders have the voting powers? voting powers? Yes or no? Yes, exactly. Why? Why they are getting the voting power at the AGMs and EGMs? They are the real owners of the business or as real owners of this company. So therefore, ordinary shareholders, they have the voting power. Do they have a fixed dividend? Do they have a fixed dividend? No, they don't. They don't have the fixed dividend. Right? If the company get the profit, so they can have the if the company gets the profit and management decided to give the dividends, so then the ordinary shareholders getting the dividend. If not, if the management decided okay not to give the ordinary share dividends, so they are not getting the dividends. Equal decide then even at the humble right. Okay. Anyway. Common stock are the financial instruments. Likewise, you can read the given part. Anyway, regarding the common stock valuation, it is little bit difficult. Right. Right. Common stock valuation is little bit difficult because of the two scenarios. Right. Because of the two incidents, two reasons, the valuation of the common share is not similar to the one valuation. Base is similar, but we can't apply same techniques and other things as we did in the bond valuation to the share valuation. Why? So what is the first reason? What's the first reason? Yes, they don't have the constant dividend. Do the ordinary shareholders have the constant dividend? Yes or no? No, they don't. But if you are having a bonds, are you getting the same coupon payment during the maturity period, during the holding period? Yes, exactly. But for the ordinary shares, they don't get the fixed dividends. Therefore, we can't identify the total of dividend to the present value context. Then in a present value context, total dividends and by some are outdoor, some are outdoor. Yeah. Right. The other reason, ordinary share dividends normally are having what? Growth rate. What do you mean by growth rate? Growth rate constantly with the EPS. What do you mean by EPS? So these are some new terms. EPS, earnings per share. Right? Earning per share. How you can identify the EPS? Total earnings, net income divided by number of ordinary shares. Right? So there are some companies who give the dividend according to the EPS, according to the increasement of EPS. With that, we can identify always the dividends are now growing. Right? So therefore, most probably the last year dividend is not equal to the this year dividend. Even consequently they are getting the dividend. Last year dividend is not equal to this year dividend. This year dividend is not equal to the next year dividend. So therefore, because of these two reasons, identification of the value of a share is little bit difficult but very interesting when compared to the bond valuation. Really interesting sessions. Right? Okay. Okay. So then we'll identify two ways of valuation for the ordinary share valuation. So therefore, write it quickly. Common stock valuation include or else can be done through the two methods. The first one, dividend discount model, and the other one, price multiple model. Right? Common stock valuation is based on the dividend discount model, and then the other one, price multiple model. Right? Dividend discount model and then the price multiple models. As name implies, in the dividend discount model, we are considering the dividend and then the dividend growth rate. But in the price multiple, we are not going to consider the time value of money, and we are not going to consider the dividend amount and etc. So there are some comparables. With that comparables, we are determining the price of the share. We'll discuss one by one detail. The method number 1, write it down. Dividend discount model, or else write it down. Valuation of share price. Write it down. Valuation of share price. Valuation of share price based on dividend discount model. Make it as a main heading. Dividend discount model. Dividend discount model. We have two models. The first one is DDM. We call it as a DDM, dividend discount model. The other one PE multiples, or else price earnings multiples. Highlight it, bold it, underline it, do everything for that topic. No, not allowed to erase. In the dividend discount model, we consider two cash flows, but those two cash flows, as we previously discussed, the first cash flow is one, dividend you are getting on, and the other one, expected selling price of this asset or as the share. Again, under the dividend discount model, we can value the shares based on two main techniques. First one is we can consider the holding period of the share and then value the share. Right? In the dividend discount model, we can have the holding period. තියාගෙන ඉන්න කාලය අනුව අපිට මොනවද කරන්න පුළුවන්? value කරන්න පුළුවන්. Right? Based on the holding period. The other one based on which one? Based on the growth rate. Based on the dividend growth rate. The other method based on the dividend growth rate, you can value the share. Right? So these are different techniques. Right? Under the holding period, we can identify one holding period, or else 1 year we are keeping this share for 1 year. If it is so, how you can value? Multiple period, if the investor keeping this share for more than 1 year, how you can value? In that sense, what we are based on, මොකක්ද අපි බේස් කරන්නේ? තියාගෙන ඉන්න කාලය, holding period. Right? The next method, we need to consider not only the holding period, we have to consider the growth rate as well. So therefore, in this model, again, which is coming under the dividend discount model, we value the share based on the growth rate. Growth rate, වර්ධනය වෙන rate එක අනුව අපි value කරන්න. Under that one, we can identify companies, they don't have the growth for the dividend. Some companies, they have the constant dividend. And some companies, they have the differential dividends. Some companies, they know growth rate last year 5, this year 5. Some companies, they know, CN පහගානේ වැඩි dividend. Some companies, they know, අවුරුදු 5කට 105යි, ඉතුරු අවුරුදු 10ට 130යි. ඊළඟ අවුරුදු 20ට 150යි. And ඒ වගේ scenario එකක් આવොත් අපි කොහොමද value කරන්නේ? So this is the overview of the DDM model. Is that clear? So we are going to study one by one. මේකින් එක discuss කරන්න යන්න. So therefore, if you can draw this one, that is better. You can draw this one and you can name this each and every the valuation methods according to your own name, and then once after you draw this one, name the topics according to your numbering order. මම මේක තමයි කතා කරන්න මම දීලා තියෙන්නේ but you can make your own models. So then it will be very easy to understand where we are in now. අපි මේ කතා කරන්නේ එක විදිහට shares value කරන්නේ කොහොමද කියන එකයි. ඔයාලට මතකද bonds වල අපි identify කරා zero bonds, sorry, perpetual bonds and then the other one, what is the other one? Coupon bonds and then the other one, what is it? Poor discount bond. එතන නම් තුනයි තිබෙ මෙතන ඊට වඩා වැඩි ප්‍රමාණයක් We'll go to the first method. It's based on the holding period, right? Holding period. Again, make the heading holding period. By considering the holding period of the share. Okay, write it down. Holding period. Make the heading holding period. Holding period. And below that, write it down. By considering the holding period of a share, or else this model identified, or else we are going to, by considering the holding period of a share, or by considering the holding period of a share, we can calculate the value of a share here. We can calculate the value of the share, according to this model. What we are considering holding period, right? The time period that the investor keeps the share. Right. And the next one, single holding period. Single holding period. Dividend discount model के holding period के single holding period. What do you mean by the single holding period? In this particular scenario, investor keeping or investor hold the stock for a 1 year period or else 1 period, right? Investor hold this share for a 1 period, for a 1 year period, right? If it is that kind of a share, how you can value that share? Now take the step. What we need to consider? We need to consider the intrinsic value. Right? If it is an intrinsic value, that means present value of all future cash flows. Make a lazy. Basic intrinsic value. Present value of all future cash flows. Regarding this 1 year holding share, what are the cash flows do you have? Cash flows. Now thinking exactly for a first year dividend, and the other one, what is it? Expected selling price, right? So therefore, you need to consider the value of the bond equals next year dividend, right? Here in after we called dividend as a DIV 1, dividend DIV, or else you can name it as a D also. D means dividends, right? So then DIV 1, what do you need to consider is the next year dividend? Why? Why do we need to consider the next year dividend? Yes, at the real context, at the present context, are we going to have the dividends? No, we are going to have the dividend in the next year. So therefore, you need to consider the next year dividend, converting the next year dividend to the present context by dividing it 1 plus R to the power n, and then you have to consider the expected or else the selling price, right? P1 equals, what is this? Price of the stock in the next period, that means selling price. So this is how you can take the value of a share if it is a single holding period. Is this clear? Right? Okay. Write down the formula. You don't need to remember the formulas, right? What you need to consider is the base. What's the base? Intrinsic value. Intrinsic value, future cash flows. Regarding this specific case, what are the future cash flows? And then, if it is a future cash flows, again, what you need to do is you need to convert it to the present context. Make a lazy make it there. I don't know the group assignments. I need to divide you into groups. I need to divide you into groups. Okay, no? Very good, no?
Yes.
I'm dividing you into groups, so then you have the chance to mix up with the other students as well, and then have the relationships. Okay. Okay. I hope you draw the or if you write down this formula, you got the question. That means represent. If I divide you into groups, that's it. Okay, do the question number 1. Example number 1 for the single holding period. How many students do we have? How many students do we have? 80. Expected dividend means next year dividend. And then expected selling price, next year selling price. How should I divide you into groups? MIS groups හැබැයි සමහර groups හරි ළමයි කියලා කියන අටවරක් 13 කියලා කියන්නේ 20. හතරක් කියන්නේ 20ක් 104ක් කිසි group එකක්. කොහොමද ඕවර්ස් නැති ඔන්ලයින් ළමයින්ට දෙන්නේ. ඒගොල්ලෝ අපි ගන්න. ඒගොල්ලෝ අපි ගණන් කරන්නේ නැහැ. Okay, now the question number. They want my group assignment is regarding the individual lessons. Right? So I will give the lessons to you. So we have the 14 lessons now. And around 15, we are not giving in the derivatives. Just we are giving the introduction. Anyway, my assignment is regarding the first lesson to the 10th lesson, preparation of summaries. Right? You have to read the lesson and then you have to prepare the video. Right? Plus, you at the end of the video, you need to identify how the identified lesson practice in the week. For example, the introduction to the financial management. The group who is selected for the introduction to the financial management, they need to give the, what do you mean by the introduction to the financial management? They don't need to present my presentation. They have to present, they have to take the facts and figures and they have to disclose it, what is mean by the lesson. And then they have to explain how the finance management concept are practiced in the real world organization. That is my expectation. Mage එක lesson එක කොහොමද industry එකේ practice වෙන්නේ කියලා දැන් ගන්න. So then you can have the industry exposure as well. I know you can prepare the videos and then we will prepare the one YouTube page. And then we'll share that in the YouTube videos among your friends and we'll see who are getting the most views for the videos. Now you have to present it. Not AI generated videos, you have to present your thoughts. You have to explain those things. I will show one video for you. So then you can do like that. Sometimes you can interview one person and then get the industry exposure. Once after you summarize the lesson. That's your creativity. AI ki kadagan inda naha. I will give the instructions. Why the monkey like a කොහොමද කරන්නේ? එක lessons 10ක් තියෙනවා. මම මේ lessons 10 දෙනවා group වලට කඩලා. ඒකට ඒගොල්ලෝ explain කරන්න දැන් share valuation නම් වෙන කට්ටිය share valuation කියන්නේ මොකක්ද කොහොමද share value වෙන්නේ කියලා කිව්වා. company එකක් select කරගත්ත එයාගොල්ලෝ share valuation කරන්නේ කොහොමද කියලා කිව්වා. විනාඩි 10ක presentation එකක් තියෙනවා. In between 10 to 15. तर मैं next week ना group presentation list එක දෙන්නම් ඔයාලට group list එක. එතකොට මම ගන්නවා presentation 7th week එකේ ඉඳලා දවසින් දවස ඔයාලා lesson එක ඉවර කරා video එකක් බලුවා ගෙදර ගියා. तर මට ලේසි ඔයාලට 7th time මදිනේ all the ones said we say who are going to have a 1,000 plus meetings. But you can prepare the TikTok videos as well. Anyway, what you need to practice is of the identified management concept practice is a real work. But the answer for this one, I don't understand. The next one, multiple periods. All are very energetic and showing the questions. I'm very happy about it. Okay. Right. Multiple periods. මේ track එකේ ඉන්නෝනේ නැත්නම් හෙට මේ පුරාම මේක අමාරු වෙනවා හොඳද? ඩාර්ක් ලේසි ලෙසන් එකක්. ඒකට අගින් ඉන්නෝනේ කිසිම ප්‍රශ්නයක් නැහැ. ඩාර්ක් ලේසි. වල මේ රත්න 18 එහෙමම ගන්න පුළුවන්. Okay. නෑ වෙනස් නෑ right. Okay. Multiple periods. What do you mean by multiple periods? More than 1 year. Okay. The more than one, the investor keeping this or else hold this share more than 1 year period. That means you need to consider what? Now this is same as the bond valuation. The first part, what is this? Present value of the all dividends that you are getting on this share. Thus, expected selling price after the expected holding period divided by 1 plus R means converting it to the present context, and then here the sum is the total of the present value of the dividends. Is this clear? Same as the bond valuation. PN. Why we are taking PN? We don't know here the expected holding period. Right? Right? T means, what do you mean by T? What's the difference between T and N? This is the duration. T means dividend in the first year, dividend in the second year, dividend in the third year. It's going to be changed. So therefore, we come up with the letter T. We don't know the time period. So therefore, total of these dividend. This summation sigma for D and P1 divided by 1 plus R to the power T. Only for that one. And then this is what? This is expected selling price after the n number of periods. අවුරුදු n ගානක අවසානයේ විකුණන්න බලාපොරොත්තු වෙන ගාන එයා divide කරනවා 1 plus r to the power n. දැන් මෙයා අවුරුදු ගානක් ක්‍රියා ගන්නවානේ මෙයා keeping this share for more than 1 year period. That means it implies we are getting dividend for several years. If it is so, you need to consider what? The total or a summation of future dividends. Okay. Question number 2, example number 2. Read the question. Investor looking for a 4-year investment. That means definitely investor holding the share for how many years? 4. That means N equals N equals 4. Right. Now share is trading at 75. That means what is this? This is P0. Currently, share is trading at 75. And then they have the plan. That means company. They have the plan to dividend as follows. For the first year and the second year, they pay the dividend 7.5. You can technically come up with the DIV1 equals 7.5 and DIV2 second year dividend 7.5. Right? So this is year 3 dividend. How you can call it then? DIV 3. I have to make you feeling happy, you know, that's why I have taken several indications. Otherwise, you feel boring and then I can't click. DIV 3, how much is it? 9. DIV 4, that is, write down this one first. N equals 4, and then P0, 75, and then these DIVs. Okay. Then R equals, can we R here? R required rate of return 12%. R equals price at the end of the 4th year. What is it? P4 equals 70. If I graphically illustrate this one in the timeline, here 0, P0, 75. We have 4 years, 1, 2, 3, and first year, second year, third year, 4th year. DIV 1, 7.5. DIV 2, 7.5. DIV 3, that's 9. DIV 4. How can we see DIV? We have a PN. Where do I need to place the P4? Yes, 4. P4, 7. So then, what's the basis? Intrinsic value. What do you mean by the intrinsic value? Take the present value of the future cash flows regarding this asset, that means share. How many cash flows do we have? 1, 2, 3, 4. Converting those things to the present context, and then plus we have the 70 expected selling price at the end of the 4th year. Convert that one to the present context and take it on. That's how we are going to do it. Converting DIV3 and then DIV4 and take the total at 70 conversion. So this is what the formula about. Right? If you read your formula, this is what the formula about. This part is denoted with the sigma. Right? This part come up with as a Pn divided by 1 plus R to the power n. Right? This part sigma DIVT. Then what about DIV divided by 1 plus R to the power T. T first year, second year, third year, fourth year. Right? Now convert it. This is easy. අවුරුද්දෙන් convert කරන්න. ඒ කියන්නේ ඇත්තටම value equals. Now I will write it down. Value equals sigma. Sigma DIV1 divided by 1 plus R to the power T. T means 1 plus DIV2 divided by 1 plus R to the power 2. DIV3 divided by 1 plus R to the power 3. When you have the labas, third one, fourth one, DIV4, that's the dividend received at the fourth year divided by 1 plus R to the power 4. Now this part is identified as a summation and the other part expected selling price and this P4 divided by 1 plus R to the power 4. Okay, we'll do it. P4, how much is it? It's 17 divided by 1 plus R 0.12 to the power 4. Right? DIV1, it is 7.5 divided by 1 plus R. R is 0.12 to the power dividend is occurring at the end of the first year. So therefore, it should be discounted with the 1. Right? Second one, DIV2 at the end of the second year. So therefore, 7.5 divided by 1 plus R, it is 0.12 to the power, tell me to the power, now this is 2. So therefore, to the power 2 plus DIV3, third year dividend, converting the third year dividend, 1, 2, 3. 3 times. 9 divided by 1 plus R 0.12 to the power 3. The last one, fourth year. 1, 2, 3, 4. So therefore, it's 15 divided by 1 plus R 0.12 to the power 4. This part is denoted with the total or a sigma. Take this total and then take total and add to the 30% value conversion. So this is the value of the bond. Take the total here. How much is it? Total of dividends. Total of dividends. 28 point. One and this one. 44.49. Now take the board. How much is it? 73 point. 1. This is the value of the share. One is wrong. Why? You got the same amounts? Okay. Right, so then we'll wind up for today. So now we have completed the holding period. 16 we are starting with the dividend. So